Ladies and gentlemen, good day and welcome to the Q2 FY26 earnings conference call of Gateway Distriparks Limited and Snowman Logistics Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. Please note that this conference is being recorded. Before we proceed, we request participants to include their firm's name alongside their name in the Zoom display. Today on the call we have Mr. Prem Kishan Das Gupta, Chairman and Managing Director, Mr. Ishan Gupta, Joint Managing Director, Mr. Samvid Gupta, Joint Managing Director, from Gateway Distriparks Limited, Mr. Karthik Sundaram Iyer, CFO, Mr. Rajguru Begal, Chief Business Officer, Mr. Manoj Singh, Chief Strategy Officer. From Snowman Logistics Limited, Mr. Padam Deep Singh Handa, CEO and Director, Mr. Raghav Garg, CFO. Ladies and gentlemen, we will now directly begin the question and answer session. Anyone who wishes to ask questions may use the raise hand option. If you wish to remove yourself from the question queue, you may click on the option again. You may please click on the raise hand option to ask questions at this time. Participants are requested to unmute themselves before asking their questions. We'll take a minute and then we'll open the floor for the Q&A.
Michelle, please make an announcement. Michelle, please make an announcement that the firm name is must besides the name of each and every participant.
We would request all the participants to mention their firm name. They may rename themselves if they are joining the queue to ask the question. I repeat, may I request all the participants to mention their firm name beside their names. Please rename yourself before asking the questions. You may please click on the raise hand option to ask questions at this time. Participants who wishes to ask questions may click on the raise hand option at this time. Ladies and gentlemen, you may click on the raise hand option and mention your firm name beside your names. The first question is from Yash Tanna. Please introduce yourself and proceed with your question.
Yeah, hi. Am I audible?
Yes, you are. Please proceed.
Yeah. Thank you for the opportunity. So my first question, I just wanted to know the EBITDA per TEU for this quarter for rail and CFS for GDI.
Hi. So the rail EBITDA per TEU is around 9,300 and CFS is at 1,000.
Awesome. Okay. And as the volumes sort of try to pick up, and I'm talking not from the next few quarters perspective, but from probably from a more medium term, let's say a 2 to 3 year outlook, where do we expect this number to go to as double stacking increases and hopefully we get connected to the DFC gets connected to Nhava Sheva. So what's the outlook here?
We're expecting double-digit growth, closer to maybe 10 to 15% is a good range that we're looking at from our existing locations, not counting Ankleshwar and domestic volumes, or any other new location.
Okay, so 10 to 15% volume growth, this is right?
Yeah, so this is basically because of the the trade deals that we're negotiating with UK being implemented. EU and US should get closed by then. The other countries also. Yesterday, New Zealand was also announced that it might get closed. So there's a lot of positive traction coming in. And then the shift from road to rail, that will also help with the DFC connecting to Nhava Sheva.
Got it. And so in that sense also, I'm trying to understand this EBITDA per TEU number. So will that also inch up? And if yes, what number can this go to in the next 2 or 3 years once the volumes pick up?
So EBITDA per TEU, we've given some guidance in the past, but going forward, it'll be a different way that we'll be measuring. Because as we start more domestic volumes and more shorter distance volumes, say with Viramgam and Ankleshwar growing, It's not the right base to look at it if we keep this 9,000 to 10,000 range.
Right.
We'll figure out a metric and get back to you once those volumes start.
Sure. Got it. And sir, the other one was this domestic services that you guys have commenced now. As far as I remember, earlier we were not getting into domestic, probably because the profitability wasn't that much. So what changes our thought process here, and what is the opportunity here? How much incremental, let's say, top line and bottom line can be generated in the next 3-4 years from domestic?
The market has evolved over a period of time, and people are more open to rail for domestic versus just road. And the location, Ankleshwar, makes sense because a lot of domestic distribution takes place from there. We're trying to balance as much and trying to find return load. It's hard to put a top line number to it, but we are looking at it from a longer term view where we want to do 1,000 plus TUs of domestic in the next 2 years per month. And then look to grow from there. And while we expand our network to other locations also, then we can increase this number further. And then just relying on pure EXIM, I mean, we had announced 3-4 years ago also that eventually our long-term plan would be to get into domestic. It still won't be a major contributor like EXIM, but maybe 10-15% of our business can be domestic after a few years.
Got it, sir. And is this expected to dilute profitability in any way?
The per TU margins are lower on domestic, but then it's the same team doing it. It's the same set of trains and terminals, so the overheads aren't increasing. So it's an incremental top-up, and we'll be using hub and spoke. We'll be trying to double stack as much as we can along the Western DFC. So again, that's why I was saying earlier that it's hard to put a number to what EBITDA per TU can look like maybe a year or two down.
Right. Got it. And the other question was on Snowman, actually. So I think on Snowman, one change that we have observed since the last few quarters is that on a PBT level, the transportation margins have completely gone away. So we are just sort of breaking even there. So what is happening? So how will this change? I think at one point in time we used to do 7-8% PBT margins on the transportation vertical as well. Now I understand that I think there were a few new assets capitalized, but now what's the plan to get back profitability there?
We are working on, there have been certain cost.
Hello.
Is it audible now?
So your voice
you're
is
a little bit distant, yes.
Okay. So in transportation, we are working towards realigning the entire business model, and this is the quarter wherein we are going to reassess and a lot of new businesses which are being brought back. This will boost up the entire profitability, and we'll go back to where the numbers were few quarters back.
Okay. So this is at like a high single digit PBT margin, are we referring to?
Yes, that's what we are targeting at. So at EBITDA level, we have turned positive and with a reduced top line, and further improvements are happening in the entire. We are redoing the entire metrics once again.
Okay, got it. So can you slightly elaborate on what the realignment process looks like, and are we reducing the low profitability customers? What is exactly happening?
So some of the vehicles which were off-road were earlier operated at a very negative margin. Those are now moved out, and the fleet will be refurbished, which will help us to increase the profitability.
All right. Got it. And sir, on the warehousing front as well, so I think last quarter we did see growth. We moved to 60 crores sort of a top line, and this quarter again we are at 60 crores. Now with the new facilities commissioning, what's the outlook here from a 1 to 2 year perspective?
In long term, definitely there is a growth which is as per our plans, and quarter by quarter we are achieving our budgeted numbers. That's something which I can tell you.
Okay. So any outlook that you would like to, highlight for us?
Not at this point in time, but definitely we see good positive quarters coming ahead.
Sure. And I think the final one on the warehousing segmental margins again. So I think we were doing last quarter was 12% PBT margin. This quarter is a significant dip. It's 3%. So can you tell me why such significant dip in warehousing margins QOQ?
One was on the utilization part of the overall capacity which was there. Some new capacities were added and the overall utilization was reduced. Other was our existing couple of warehouses also had a stress because of seafood and other elements, a couple of those warehouses, which has actually led to reduced margins. And then third was weather, which was quite patchy this time, which has increased power cuts, and we have had a considerable diesel consumption in the warehousing unit.
Okay. And going forward in the next few quarters, do we expect this to reverse and revert to the mean, 10, 12%-ish that we were making?
Yes, we are seeing positive traction from December onwards till the year end. We are expecting good volumes.
Got it. All right. Thanks, sir. I'll join back in the queue if any further questions.
Thank you. A reminder to all the participants that you may please click on the raise hand option available on your screen. You may also rename yourself with your firm's name so that we know which firm you belong to. I would request all the participants to introduce themselves and go ahead with your questions. Please mention your firm name before asking the questions. We'll take the next question from Vikram Suryavanshi. Please introduce yourself and go ahead with your questions.
Okay. Hope I'm audible.
Yes, sir. Please.
Hi. Okay. Hi. Good evening, sir. I'm Vikram from Phillip Capital. This CFS EBITDA per TEU, basically, the number is pretty low compared to normal range. So any specific reason for this quarter, or that is like a new normal?
No, there were some one-offs, which included, say, legal costs and repair and maintenance. There was also a dip in exports because of the US tariff situation. So we should see this improving in the coming quarters.
Okay. So can we come back to like a 1500 plus or something like that, or probably?
So I think the range we've given in the past is 1300 to 1400. That's still the target going forward.
Understood. And how is the basically things are quite evolving, particularly with the US trade barrier, but in terms of ground level, has it continued to impact volumes, or there is still underlying some base volumes which are continuing despite tariffs, or how you import export mix, if you can comment on that?
Imports are going strong, but export side we saw a dip, and part of it is because of the US tariffs. Maybe you can say about 4 to 5% of our volumes were lower on that account, but it has stabilized over the last month or so. But until the trade deal is finalized, I don't think we'll get back to the earlier numbers of export, plus a growth on the exports that we were looking forward to.
Okay, understood. And domestic side, the business what we have started from Ankleshwar, what is the second leg? Is it like in Mumbai or something where we have a region which comes and then we distribute, or how is the basically strategy to develop a network on a domestic?
So right now we're servicing from Ankleshwar to north. Part of the containers have gone towards Ludhiana, some to Jammu, some within NCR. So we're trying to explore as much within our network that we can, but we're open to other opportunities also to regions where we don't have a full-fledged ICD, but we can operate out of a third-party terminal or a CRT.
Okay. So currently we have a type with basically third-party terminals for north distribution, or we are using existing terminals?
For north, we're using all our own ICDs in Ludhiana, Garhi, Pyala, Kashipur.
Okay. So any plan to then bid for this Indian Railways terminals, basically?
Which ones?
Indian Railways terminals under the Shakti and
No, if something good comes, we'll have a look at it, but right now we haven't applied for any opportunity with them.
okay. And we also had a plan to develop our own satellite terminal. So any progress on that front?
No change on that situation.
Okay. And any update on Jaipur?
No change again.
Understood. Oh, okay. Thank you.
Thank you.
Thank you. The next question is from Kunal Tokas. Please introduce yourself and proceed with your question, sir.
Hello, I'm audible.
Yes, sir.
I'm Kunal from Fair Value Capital. Just one question on Snowman. What is your CapEx plan, capital program for Snowman for this year and for the next few years?
So we'll be roughly spending about 100 to 150 crores per year, and primarily that is on making 2 to 3 owned warehouses on owned land. Other than that, we'll have some small capex on build to suit or transportation, increasing our fleet, and we're exploring some EV and CNG vehicles also going forward. And then we'll also be getting maybe 2 facilities a year on a build to suit model.
And just for clarity, can you also maybe specify what your preference would be? Would it be to own warehouses and vehicles, or would it be to be more asset light and lease those assets?
No, our preference is actually it's a two-pronged strategy. So for the warehouses, we want to own the land and construct on our own and do capex out there. And on the asset light side, we will continue where a fully built up facility is available for lease. We will not be doing a mixed lease where part of the assets are leased or the land is leased and the warehouse is done by our capex. So either fully owned or fully leased.
And how would you decide between the two? Say for any particular location where you have to buy the land and build it yourself or lease it?
There is no difference for us. So as and when what our cash flows allow, we will spend that much on our own capex, and beyond that, whichever opportunities we get for BTS, we will do that.
And the ideal size of a facility that you would be looking at would be how much?
It depends on the city and the market, but roughly on average 5,000 pallets per facility is what we're looking at.
5,000. Is there an idea or a market preference towards slowly increasing these capacities as the market matures?
Yeah, like so tier 1 cities are more, mature, so we would look at bigger capacities there. But tier 2, I think 5,000 now is possible. Then tier 3 is where we would look at, say, BTS or Park and Pay, which could be smaller facilities.
All right. Okay. Got it. Thank you very much and have a good day.
Thank you.
Thank you. Participants who wishes to ask questions may please use the raise hand option. Please click the raise hand option to ask questions at this time. The next question is from Ashish Soni. Please introduce yourself and proceed with your question.
Yeah, hi. I am Ashish Soni from Family Office. So I have just 2 questions. What risk mitigation steps you have taken to avoid US tariff impact to strengthen our business? That's number 1.
So we've tried domestic market. That's what we're trying to do. But other than that, I mean, as a macro, we are a middleman. We're not controlling where the trade is going. We were always targeting other countries' volumes also, so it wasn't that we were US heavy or anything like that. So where the overall trade goes is where we go.
Okay. And other point you mentioned that you had some energy consumption because of power issues. So where is this region, and are you taking any steps to mitigate that going forward? Because your warehouse business can get impacted because of that, right?
No, typically it was, it is for few of the warehouses, typically in south, wherein the power cuts were higher, and that was in general because of heavy rains or downfall, and the lines went down. Nothing we could do. All we are doing is get the maintenance done, and it is done and up and running.
Okay.
Yeah, waterlogging has impacted that.
Okay. And all these FTAs, I think you mentioned few of them. So any other FTAs which can positively impact our business? You spoke about UK and maybe probably US and New Zealand. Any other thing which you think can give positive flip the FTAs, because others are also in pipeline, right?
Yeah. So UK, EU, US will all help in increasing exports out of India. Imports is going strong, and lately there's been a lot of talk of India and China restarting a lot of imports coming in from China to India, so that will also help. And even the smaller countries where it's, there's been Oman, Philippines, New Zealand. There was lately something about Australia restarting seafood exports to there. So all these initiatives will help the overall container volumes in India.
Okay, sir. Thanks and all the best.
Thank you. The next question is from Slade Alexander. Please introduce yourself and proceed with your question.
Yeah, hi, good evening. It's Slade from Artha India Ventures. So my question is for the management of Snowman. In the management commentary in the presentation, the reason for the transportation segment declining was given as a shift in the customer mix. So can you please elaborate on that? What does that mean? Did you lose customers, or what exactly was that? And then it also says after that, we expect a recovery in the coming quarters. So are there any customers in the pipeline, any particular names that you all can give? And the fleet optimization that is given, so will you all be moving more towards the leased model and reducing the own fleet? Or just, if you could explain how exactly do you all plan to recover?
Okay. In terms of fleet optimization, I'll go from third to the first question. So in terms of fleet optimization, we are moving out the aging fleet and replacing it with a new one, adding few new ones. Most of that will be on lease, other than the capex, which we already mentioned in the other question, answering to other question, that we will be doing some capex in transportation as well, which will help us have a better utilization of the assets. The breakdowns or expected breakdowns will reduce. That's one part of it. In terms of the customer mix, because of this GST change, there had been there had been some impact, as we don't operate in 5% GST yet. We're trying to work out how much is the impact. But yes, few of the customers, they have opted out, especially the restaurant brands which were with us. So we have lost a little bit of it, but not considerably, though the team has started working on different products, and we are gaining traction in those. Our exposure in ice creams is increasing with the ice cream players. It has increased, and that is giving and driving the growth at a much better revenue. So we are focusing on ice cream brands as of now.
Okay. And also about the customer mix for the 5PL segment. So you all have mentioned Unilever and Copic, but these were there a while ago, right? So are there any new customers in the pipeline for this for FY26?
We have added new location with Unilever. That's one part of it. And 5PL is one business wherein the pipeline always remains very narrow, but it's a long conversion process. There are a couple of customers with whom we are working right now. The names, because of the NDAs we have signed with them, cannot be disclosed. But yes, we are working on 2-3 major accounts in the same space.
So just to confirm, these 2-3, are you all targeting to close them in FY26 itself?
Yes, that's, at least one of them will be closed in FY26. The operations may start in Q2 or Q1 of FY27.
Okay. And sorry, just one last question I wanted to ask. is more towards the management for Gateway. So about the creeping stake that you all have been acquiring, is there any final target that you all plan to achieve to hold for the with regards to the ownership of Snowman?
I think we clarified this the last few calls that our target was to reach 50%, just cross 50%. And as of now, there's nothing immediate in plans for us.
Yeah. Okay. Thank you.
Thanks.
Thank you. Please click on the raise hand option to ask questions at this time. The next question is from Jignesh Makwana. Please introduce yourself and proceed with your question. Mr. Makwana, please unmute yourself and speak.
Yeah. Hi, Jignesh here from Asian Market Securities. If you can provide a market share across our ICDs, how has been the competitive landscape over there? And if you can quantify the double stack volumes from the Faridabad ICD, that's one.
Yeah. Hi, Rajguru this side. So our market share in NCR is still hovering between 16 to 17%. In Punjab market, we have increased our market share to 27%, and in Uttarakhand it is 38%. So there has been growth in the market share, especially in Punjab as well as Uttarakhand.
Okay.
Regarding double stack, so we have increased our double stack percentage from 39%, which was last quarter. This quarter is 41%. And we don't calculate double stack percentage terminal wise. So basically, it's a hub and spoke model wherein we do double stacking planning considering the volumes of all the terminals. So we don't do a bifurcation. And we see a very positive outlook, especially in terms of import volumes, which have been growing. Though there has been temporary blip in the US export scenario, but as we have already conveyed that, things are going to improve. But keeping in view of the pendencies which are at the port, so we are anticipating a robust growth in coming few months.
Yeah, sure. But I do agree you can't quantify the double stack, but if you can qualitatively give some ballpark number that because of commencement of double stack operation for Faridabad, how much incremental, maybe in percentage, it has been supporting to rail volume? Because we have been doing 90 to 95,000 containers every quarter, somewhat 35,000, 33,000 kind of containers monthly run rate. Now we already crossed 1 lakh kind of containers in this particular quarter. So if you can qualitatively say something on that part. And second, the last one from my side, how has been the empty running position in this particular quarter?
So again, it's not possible to break it down terminal wise. Faridabad, even before it got double stacked, used to be hubbed at one location or another, so it was getting double stacked. But there are some direct cost benefits out of double stacking directly versus double stacking out of a hub. So that's pretty much all we can say on that. Regarding empty also, sorry, we don't share a split between laden and empty numbers either.
Actually, why I was asking this particular part, because despite our double stack has been increasing, but if you look at our EBITDA per container in rail segment, I think last year it was around 9,800 rupees. So now we are down by about 400 rupees in YOY basis. So I'm not able to get why the margin, absolute margin per container has been on a pressure side.
There are many reasons. One is competition. One is an imbalance is there. Empty running is part of it. Lower double stacking in certain routes. So mix towards ports changes. Weight slab changes. Transit time also was slightly better last year versus this year because there is port congestion going on. So it's not just a simple 1 or 2 line factor that just translates directly into EBITDA per TEU. Also annual costs increase, inflation is there, costs increase, so that has to get impacted somewhere as well.
Okay, thank you.
Thanks.
Thank you. Please click on the raise hand icon to ask questions. The next question is from Vikram Suryavanshi. Please proceed with your question, sir.
Hello. Am I audible?
Yes, sir.
Okay, sir. Thank you. So most questions were answered. Just one clarification on the domestic side. Probably we'll need our own equipment, containers. So how is the plan there, or are we currently will do trial and test the market with lease? So you can, is there any CapEx plan for the container addition there?
So we had a fleet of about, we had an inventory of about 800, 900 owned domestic containers. So we'll be looking to use those. Plus we've taken some on a short-term lease. So we'll try that out, and we're also buying some. But the cost of a new container is not that much. It's about 3.5 lakh to 4 lakh rupees per 40 feet container for a brand new one. And we can evaluate buying a second-hand container also. So the capex on containers will not be that large.
Okay. And in case the new one is we choose to buy, probably will import from China, or now we have domestic supply available at competitive price?
We have both options, so we'll evaluate whichever is better. Whatever is more cost effective, we'll compare both domestic and imported.
Okay, but currently I guess China could be still cheaper, or?
It's unclear because right now we've gone for the lease model.
Okay. Understood. Thank you.
Thank you.
Thank you very much, ladies and gentlemen. That was the last question for today. Participants that have missed out due to time constraint can reach out to the management and SGA for Gateway Distriparks and Snowman Logistics for any further information. With that, we conclude this conference. Thank you for joining us, and you may now exit the meeting. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.